Thank you for checking out Real Talk Personal Finance. Shit's about to get real. Cash Flow King with you today. And today on episode 52, is your home really an investment? Featuring Equity Stacker. That's right. We got a very special first-time guest with us today. But before we introduce her to the show, a few quick announcements as always. First, I wanted to let everybody know, especially our premium subscribers, that Cube Crusher unfortunately had to attend to some funeral services recently. So the quarterly e-newsletter that we typically put out each quarter after quarter close is slightly delayed. We would ideally like to try to get it out to you guys a little bit quicker, but he's had some other things going on. So he is back now and going to be working on that. So we should have that e-newsletter out to you premium subscribers here, hopefully very soon. Also, and this applies across the board to everybody, just wanted to give a reminder that we do have some merch for the show. I recently ordered a onesie, which I think is pretty sweet. One of our friends is going to soon be giving birth to their second child. And so what better way to start that little guy off than a Real Talk Personal Finance onesie? So feel free to check out the link in the show notes. Use code RTPF for Real Talk Personal Finance, RTPF10 for 10% off. And for those of you that are premium subscribers, you have your own special promotion code that gets you 25% off. Okay, that's it for announcements. We are going to get into the show here today. We actually have with us one of our premium subscribers has agreed to come on the show. This is somebody that I know personally, and we have had this debate a time or two, and it seems to be something that comes up quite frequently in our conversations, and sort of an age-old debate on whether or not your home is an investment. And we had a conversation recently, and she said something to the effect of, I think you are the only person I know that thinks your home is not an investment. And voila, here we are in episode 52. Please welcome to the podcast for the very first time, Equity Stacker.
Well, thank you, Cash Flow King. It's a pleasure to be here.
Thanks for coming on the show. This is your first podcast, so I think everybody's going to enjoy this, and we certainly appreciate you taking the time. Before we get into some things, and I prepared my notes as I usually do, talk to us a little bit about your viewpoint and maybe what conversations you're having or have had with friends and family members and coworkers and whomever that basically are of the belief that your home is a pretty good investment. Just give us kind of a framework for how you're looking at that.
Well, I am a baby boomer, so I think, years ago not everybody could own a home, and it was always the American dream. And I think I inherited some money, which gave me a jump start. I don't know if I could have done it otherwise, possibly if I had some financial planning, but I did rent for a while, and I knew that, I had a chunk of money that came my way, and my thought was, okay, I'm gonna look for a home. I'm gonna take my time. This is a place that is going to be my shelter, and hopefully, a long-term thing. And so I started hunting for a home, and location to me is everything, and that had a huge impact on my decision and where I decided to purchase.
Okay, so you are a current homeowner, correct?
Yes.
Okay, so tell us a little bit about sort of how you think about your home in terms of it being an investment, and maybe also what some other people have said just in conversation with you about why they seem to support that same idea.
Well, just in general, I haven't specifically spoken with friends, talking about this. It's just when you and I have had conversation, I know we tend to debate it a bit, but just in my everyday conversation with others, I've never heard anybody refer to it as, not something like an investment because, just like having fees on mutual fund accounts and brokerage accounts, you're constantly contributing either through an employer or on your own. And there are fees. The market goes up, the market goes down. It's the same with the home purchase. There's repairs, there's maintenance, there's upgrades. Interest rates right now I think are up to 7% if I'm not mistaken. When I first bought my house, it was in the 6s. Now I'm down in the 2s. So again, it goes up and down. So I see some similarities in investing in the stock market as well as having a home. I see it as an investment because, I took my time, and people always told me location. You got to get a good location, because when you get a good location, and I'll qualify what I mean by that in a minute, your resale value is going to be, great, blah, blah, blah. So, the house I bought was not the house that I thought I would buy. It was in a town that I thought was too far away from everyone in my life. It was, more country, and I wanted more contemporary, but as time went on, I was renting, and I was throwing money out the window for this small little apartment that probably was more than what a mortgage was going to be. And this house was still on the market, and I kept thinking about it. And I came back, and one day it was just like the light bulb went off. I looked at the land, I looked at the house, I looked at the location. It's close to the highway, it's close to the commuter rail, it's a mile from the beach. The elementary school is at the end of the street. There's all restaurants and shops and libraries. And to boot, I'm on a dead-end street, so there's a lot of privacy, but everything is accessible. And I thought, wow, this was close to 20 years ago, about 16 years ago. And I thought, wow, I was a lot younger, and I'm thinking, but someday, I plan to be there at least 20 years, into retirement. At that time, that's how I was thinking. And I thought, whatever, I wasn't as educated back then as I am now in terms of understanding, home ownership. And so that still holds true today. I'm seeing the values go through the roof, and it is a very prime location. So I do see it as an investment because, you have equity. Now, some people take that equity and they buy other homes, or they do, home equity loans and fix up their house, which I've done, but I've paid that off. But, as time goes on, I'm paying the principal. I'm paying down the principal every month. Whereas paying rent, I'm not able to write off interest or anything like that. So I do see it as an investment because if I did need money, I could always get an equity line. If I decide to sell, I will make a profit as of today. And I know, again, like the stock market, everything goes up and everything comes down. So I hope that answered your question.
It does a little bit. And thank you, first of all, for providing your perspective. I appreciate it. I'm sure the listeners appreciate it. And quite frankly, there's no one right answer. We're each going to sort of, I don't want to use the word argue, but we'll debate our own points. And then you as the listener, again, we don't give any advice on the show, but this is for entertainment and education only. You can formulate your own decision and your own conclusion. And so I think everything you said, I'm going to, I hear you, but I have to disagree with some of that, right? And so first thing is, and I heard this on another podcast recently, which I thought was kind of comical. They said, when you buy real estate, and this was in the context of real estate investing, not as a primary residence. And for the purposes of today's podcast, we are specifically going to be talking about owning a home as a primary residence. But there was a comment made about, real estate is very forgiving. It's kind of like a bad haircut, right? So if the barber screws up and they, shave an extra spot on your head or something, or they missed a spot or whatever, within 4 to 6 weeks, it's typically going to grow back and no one's ever going to know, right? And I'm not saying that 4 to 6 weeks real estate is going to change. It doesn't turn on a dime like other asset classes can. But generally speaking, the longer somebody holds real estate, the more likely it is that good things can happen. I think we would probably both agree with that point. So that's first. The other thing you mentioned was, and I think we may have touched on this in previous shows, that renting is throwing money away. I would have to respectfully disagree with that because I think that renting has value. Now, are you building equity? And we'll talk more about this as the show goes on. As a renter, no, you're not, right? You don't own anything. However, there's something to be said for things like you mentioned upkeep and repairs and maintenance and certain things that you're not going to have to pay for as a renter. Another thing I think a lot of people don't really think about sometimes is the fact that it gives you flexibility. What if, yes, we're working more and more remote these days in a lot of different types of positions, but not everybody can. What if you're in a position where it requires you to physically move somewhere else geographically and you have to sort of up and leave? Yes, some companies will offer to sell your house for you and pay your closing costs and those sorts of things, but not all of them do. So it allows you the flexibility to be more portable and transfer physically and potentially go somewhere else if you need to. So I don't think that it has the same positive connotation, if you will, in terms of renting versus owning. I think most people would agree that, as you mentioned at the top of the show, sort of like the American dream, owning a home is something that I think a lot of people aspire to, and that's great. But at the same time, I would say that there's a lot of people that choose intentionally to rent. And my baseline argument is that I think whether or not somebody chooses to own versus whether or not they choose to rent, ultimately, in my opinion, is a lifestyle decision. And we'll kind of talk through some of the numbers because you talked about building equity and selling for a profit and things like that. And I actually have 3 different examples that I'd like to go through at some point that kind of illustrate what this could look like. And these are actually real life, I don't want to say case studies, but real life numbers from 3 different parts of the country that I put together for the listeners for today's show. And then the last thing before I turn it back over to you really quick is you mentioned writing off the interest. And again, not tax advice to anybody. However, unless you are itemizing your deductions, which fewer and fewer people are doing as the standard deduction continues to go higher and higher, even if it otherwise would be deductible, very few people actually get that benefit. So that's just something else that at one time, I think more and more people were able to take advantage of that, which makes your effective interest rate even lower. But as time has gone on, I think fewer and fewer people are actually getting a positive financial benefit from the deductibility of the interest. So I'll pause there real quick. Did I miss anything? Do you want to rebuttal with anything? Do you want to move on? What do you want to do?
No, first and foremost, yes, with all due respect, nothing against renters out there. I was a renter, and you're right, it is a lifestyle decision. I just think that if you look at it from the vantage point of it's your primary residence, it's your shelter, it's your home, it's where you're going to build your family, build memories, all those things. If someone has a large sum of money, or not even a large sum of money, you can put 5% down. Why not purchase a primary residence? Now, again, if someone's job takes them around the country or whatever the circumstances might be, then renting could be an option for them. So that would be the only thing, I just want to make that distinction because it just makes sense. In fact, the rents today are more than most mortgages. I mean, it's out of control. And I'm sure there are renters that would love to buy a home and because of the rent that they're paying, it's crushing them. But again, it is a lifestyle decision, absolutely. But I would think if someone had a chunk of money and decided, well, what am I going to do? And they're young, I would hope that they would look at home ownership.
Okay, so go ahead.
Excuse me. And the other thing was, there are some of us who still itemize, and I think you can write off the interest as well as report on the taxes that you pay. A lot of that's in escrow, but when you prepare your taxes, and I'm not a tax expert, but I do think taxes and interest are deductible in most cases.
They can be, yes. Given the fact that you mentioned 5% down, I'm actually kind of glad you mentioned that because that is a pretty good segue into my first example, which is a Midwest home purchase with a 5% down payment. So I'm going to get into some of the numbers and I'll kind of pause after each one and we will debate and talk and discuss and see what happens. So this is the first of 3 examples, okay? This is a Midwest house purchase. Now, let me start by saying that it's going to be impossible to go over every single different scenario. So what I've prepared here, we have a Midwest purchase, we have a Northeast purchase, and a Northwest purchase that we'll go over last. And I try to put some realistic numbers together based upon, different sources and some actual numbers and data. And you'll see as that kind of unfolds. But you said something about if they have a chunk of money, why wouldn't they buy a home? I know what I was going to say now. You were talking about younger people. And so there is something out there called house hacking. We're not going to have time to get into that today. But basically, if you were to live in a property that you owned and then rent out another portion of it, whether that's other bedrooms in a single family home, whether you buy a duplex, live in one side, rent out the other half, or some variation of that, you could look at that as, in my opinion, sort of an investment. But what I'm going to focus on now is you're going to buy a home as a primary residence, and you and or your family are the only ones living there in that one unit. You're not renting any of the rooms out. All right, so number one, Midwest house purchase. This is the first example. So we have a $173,000 home purchased back in 2012 with a 5% down payment on a 30-year fixed mortgage, which based on interest rates at the time was around 3.375%. So this is going to be the first example that I'm going to go over. And basically what I'm going to talk about are the different components of this and essentially doing a time value of money calculation to solve for I, which is basically your rates and essentially your internal rate of return, to kind of put some numbers, some concrete numbers for this to prove why, in my opinion, a home is generally a terrible investment, okay? So we take this $173,000 house back 11 years ago. This person puts a 5% down payment on a 30-year fixed mortgage at 3.375%. So to come up with the down payment, that's $8,650 that they're out of pocket for that down payment. We're going to assume, say, roughly 2% of the purchase price for closing costs. Could be a little bit higher, could be a little bit lower. Yes, some people are going to say, well, you could negotiate with the seller, and maybe they give you a credit. Again, there's going to be a million variations, but just bear with me for the example here. So at a 2% of the purchase price, we have closing costs of $3,460, which means this buyer for this property would need to come out of pocket $12,110, okay? So that's an outlay. That money literally, when I look at all these, I'm looking at where are the cash flows, where's the money going? So $12,110 leaves them at the closing table, okay? Now, based on that mortgage, again, we're getting a loan now for 95% because we only put 5% down. 95% loan on that $173,000 property at 3.375 interest. Your principal and interest components of that payment only is about $726 a month. And then you have taxes and insurance on top of that, which is roughly going to be another $200 for a total of $926. Now, everyone's going to have a different number for this. But usually, depending on the age of the home and some other factors, you're going to spend approximately 1 to 2% of the home's value each and every year for upkeep and repairs. So in this case, we're just going to be conservative and use 1% of the value, okay, which comes out to $144 a month. So we take our $926, which is your principal, interest, taxes, and insurance, your PITI, plus your $144 upkeep and maintenance, which comes out to $1,070 a month. We're going to be in this home, let's say, for 11 years, which is 132 months, okay? And now you fast forward to 2023, this property that was purchased for $173 back in 2012 is now worth $290,100 according to Zillow, okay? And you might think, well, geez, right? Equity Stacker probably loves that. That's a bunch of equity. That's over $100,000 of equity. However, if you go 11 years into that mortgage and you look at an amortization schedule for the mortgage, assuming no refinances, to keep this first example simple, we still have an outstanding balance of $122,166. So if we take the difference, we say, what is it worth now? $290,100 minus the remaining outstanding balance on the mortgage, $122,166, and we subtract that, we're left with $167,934, okay? And people hear that and they think, well, that's great, especially if you've lived in the home for at least 2 of the most recent 5 years and you're the homeowner, it's a primary residence, there's a capital gains exclusion depending on your marital filing status, whether you're single or married filing jointly, for example, you can exclude either $250,000 or $500,000 of gain respectively. So that sounds pretty good. So this person would walk away with $167,934 in their pocket. When you do the math and you plug this into a time value of money calculator, okay, and you solve for this internal rate of return, you get a positive 1.50%, which means your return on that quote-unquote investment, that home as a primary residence, based on real numbers here, is 1.5%. And even if we took out the closing cost and we took out the upkeep and said there's no upkeep, there's never been any maintenance, we got a seller credit, we paid zero closing costs, the numbers still only come out to 4.07%. Not a good investment over an 11-year time period, in my opinion. Let's discuss.
Yeah, well, I think 11 years is being conservative. You know, as I said at the outset, I plan to, you know, when I bought the house, I'm like, you know, I plan to be there at least 20 years, if not longer. So I don't know why someone would you know, look at selling a house after 11 years. Maybe they want to upgrade or downgrade, or, you know, they're relocating. I think there's many factors. First, you got to look at, well, why does somebody want to, is somebody forced to sell, or is somebody have the luxury to sell? Because 11 years, I think, is a factor here. I'm thinking long term. You know, someone that buys a house, because when you invest in the stock market, whether it's a 401k, a 403b, a Roth, whatever, and I believe in all of that for long-term financial planning, you're looking at the long term. 11 years is not long term, in my opinion. So that would be the piece I'd want to debate with you. If you did the same formula over 20 years, what would the percentage be?
So I have a couple other examples that are a little bit longer in time than that first one, and we'll get into that shortly. However, the 11-year time period. So I would argue, and I think most financial services professionals would argue, that anything that you're looking at for 10 plus years would generally be considered long-term, right? Anywhere from a 5 to 7 is usually a midterm. Anything under 5 years, a lot of people would argue, is short-term. Anything 10 plus years is generally considered longer term. But what I'm doing here by doing this in this example is I'm looking at real numbers, what a property in the Midwest was purchased for at a particular time based on interest rates at the time, down payments at the time, what it's actually worth today according to Zillow based on the current market value. And I'm just taking a snapshot. And we'll go through a couple other examples that are a little bit longer in terms of a time frame. But what I think my main point across all these examples is going to be is you have to follow the cash flows. You have to follow the money. And the reality is, in a primary residence, you know, some people would say, well, you're going to spend money every month no matter what, whether you own or whether you rent. And I would say, yeah, that's true. But you're not only going to have the mortgage payment, you're going to have those other expenses, you're going to have the upkeep, you're going to have the repairs, and money, generally speaking, is constantly flowing out of your pocket each and every month without fail, even though the values, we're going to look at an example here at the end in the Northwest, where they can go through the roof. They could potentially skyrocket. And on paper, in nominal value, looking at here's what it was worth at a particular point in time, and here's what it's worth today, however many years later, and it looks like a big number on paper, when you adjust for how much of an outflow, how much money has gone out of that individual's pocket over that period of time, and you run the numbers, it's just, quite frankly, just not a good investment. In fact, some of these other ones you'll see here in a couple minutes, the returns are negative. And I'm not saying don't buy a home. Like, I own a home. There's a lot of people that have a home, or a house, but I don't look at it as an investment. I look at it as a lifestyle decision. If I want to put money into whatever, stocks, bonds, mutual funds, real estate investments in terms of rentals that I rent to other people, whatever, syndications. We've talked about all that stuff on the show to some degree. That's great, but I would argue that those truly are investments. And yes, you might still have outflows as you're building up those investments, but eventually those investments are going to start working for you. They're going to pay you rental income. They're going to pay you cash flow. They're going to pay you interest. They're going to pay you dividends. And if you follow the streams, you have inflows in those other quote-unquote investments. Whereas with this, unless and until you harvest the equity, which means you sell the home or do a cash out refinance or pull it out in the form of a HELOC like you mentioned, or any of those things, unless and until you harvest the equity, it's literally dead money, because the home value going up or down, as you mentioned, markets go up, markets go down, real estate prices go up, real estate prices go down. It's all based on it's all based on external factors, and it's beyond somebody's control. That's going to happen no matter what. So I'm looking at how much is somebody having to feed this financially every single month. And so I'm just simply putting it in as a financial model to see, okay, if we had this much money go out in the beginning, and then this much goes out periodically, and then at the end it's worth way more, and we had a gain, what's our actual return? And in this case, 1.5%. That sucks, you know?
Well, I see all your points. They're all valid points. However, what's the alternative? I mean, yeah, the person could rent and they wouldn't have to worry about repairs. They may or may not have their own parking spot. They may or may not have privacy. I mean, it does go back to lifestyle, because if you are willing to only get 1.5% return but have a beautiful big backyard, parties with, the music glaring through the walls, not worrying about the people upstairs or downstairs. I mean, there's a lot of benefits to having your own. So it is lifestyle, but I just want to ask you, you say it's quote unquote a terrible investment. In this scenario, this first scenario, this Northwest property, what would be the alternative then? If that's a terrible investment, what would you, and I know you're not giving advice, I'm not asking you to, but like, how is renting going to save that person any money?
Okay, so first of all, the first example was a Midwest purchase. We did not yet get to the
sorry.
Northwest. That's okay. First example was Midwest. The next one's going to be Northeast, and the last one's going to be Northwest. So we've gone through 1 out of 3. I would say from a lifestyle decision standpoint, it can be a fantastic investment. From a financial standpoint, I would run the other way. I don't view my home as an investment. I view it as an intentional decision to be at a particular place and have all, the things that you mentioned about lifestyle and parties and friends and privacy and all those things. Those are all great, but they don't put money in your pocket. They take money out of your pocket. Just like groceries, okay? Everyone says, oh, inflation and groceries have gone up. Okay, great. But are your groceries an investment? No, but they keep you happy, they keep you healthy, they keep you fed, they keep you nourished, they keep you all these things, but it's still money leaving your pocket every month. So to me, I would almost equate, and it's not quite a absolute parallel comparison, right? Because you can't sell your groceries later for a potential gain. But if you just look at like the consumption part of it, right? We're consuming time, if you will, in our homes, just like we consume food from the grocery store. But I would never say that my groceries are an investment. I just don't see it that way. All right, let's go into, because we got 2 more examples here, and we'll kind of go back and forth a little bit after this next one. But this one's a little more complicated. I divided this into 2 different parts. Okay, so the first one was a purchase with a particular interest rate that was fairly low and held throughout, in that example, for 11 years. This next one is going to be a purchase followed by a refinance when rates have come down. So bear with me as we go through this one. This example number 2 is a Northeast house purchase. Okay, this one was purchased in 2007. Purchase price $292,435. We're going to make the assumption that this purchase was made with 20% down on a 30-year fixed mortgage at about a 6% interest rate originally. And then later, in this example, we're going to say 10 years later, so from 2007 to 2017, it was refinanced at that time to 4%. That's just what this hypothetical example is going to be. So if this person that's purchasing this house for $292,435 back in 2007 puts 20% down, they're out of pocket $58,487 for the down payment. We're going to make an assumption that their closing cost, let's just call it $5,000. So all in, their cash flow out on the front end is $63,487. Okay? Now, if we do a 30-year mortgage at 6% originally, all right, they're going to have a principal and interest component of just over $1,400 a month. Their taxes and insurance are going to be about $414, which comes out to a total of just over $1,816 per month. And then, excuse me, just like we did in the last example, we're going to say that about 1% of the value of the home is going to be upkeep and maintenance. So if we do that out monthly, it comes out to about $243 a month. So in total, their PITI was just over $1,800 a month, $1,816, plus the upkeep and maintenance is $243 for a grand total outlay, negative cash flow every month from their pocket into their house essentially is $2,059 a month. That's what we're going to go off of here. And we assume that before the refinance, this person does this for 10 years, which comes out to 120 months, okay? Now, fast forward 10 years, all right? The future value, so 10 years later, we have $302,000 minus The outstanding mortgage balance at the time, based on an amortization schedule, is $195,780. So their equity, if they chose to sell and walk away, and we're going to continue this example, we're not actually going to sell, but if we did, we'd walk away with $106,220. And I'm assuming for all of these being a primary residence that they're walking away with this tax-free, that there's no capital gains tax or depreciation recapture or anything like that. So if we do the same thing we did in the first example, and we solve for that I, right, we actually get a negative, and I couldn't believe this when I first ran the numbers, a negative 21.74% internal rate of return. And if you do the numbers out, that person, between the down payment, closing costs, mortgage payment, upkeep, and everything else, they've put $310,567 into this home over a period of 10 years. Okay, so let's just say that's the first part of the second example here. That's part one, which is the first 10 years. And then we say, well, wait a minute, interest rates went down a little bit, and let's go fast forward to 2017, and let's assume that there's a refinance at year 10. So we're going to refinance at year 10. We're going to reset the amortization schedule as a result of that refinance, and we're just going to assume that there's nothing out of pocket, right? We're not going to assume any additional closing costs to be conservative. We're just simply going to reset the loan. So in 2017, this property is worth about $302,000, okay? So now when we redo this, okay, their payment, which is now based on a mortgage of 80% of that $302,000 value, it drops because the interest rate is lower, right? So their principal and interest is only $1,153. We're still going to have the same taxes and insurance. In fact, it probably went up, but to be conservative, we're going to keep it the same at the $414. And we're going to keep the same thing, the same 1% of the original value, which is $243 a month in upkeep. We're not going to move that up, even though chances are that's higher, just to be conservative. So if we do all that, and we take the new payment plus the upkeep, we're at, instead of $2,059 a month, $2,059, we're at $1,810 per month. Okay, and now we do this for 7 more years. So we're looking at this in total over a 17. Last example was 11. This is going to be a 17-year run. Okay, in 7 more years, the property value skyrockets. It's now worth $491,900. Because we reset the amortization schedule on a new 30-year mortgage, if we look 7 years into that table, we still owe $207,919. Which means if we sell and walk away, assuming we can keep it all income tax free, we're going to walk away with $283,981. And most people would say that's a nice chunk of change. But when we plug it back in, just the way we did before on the past couple of examples, and this time we do it in an internal rate of return calculator where we put the cash flows in and cash flows out over time, we get a negative 4.89% internal rate of return over a 17-year hold period. Again, terrible investment in my opinion. Let's discuss.
Well, what's the alternative?
There's always an alternative, but it's not saying that somebody shouldn't buy a home. It's simply saying that maybe the home is not a good financial investment. Maybe it's a great lifestyle investment. I don't think it's a good financial investment. And so if somebody has, a certain amount of money, maybe they buy whatever home they might need to fit their lifestyle goals and get the enjoyment out of that. But then if they're looking for investments, to look elsewhere and not look at their home as a good financial investment.
Well, I see what you hear what you're saying, but I still disagree. I disagree. I lost my train of thought too. I was going to say something, but it'll come back. It'll come back.
It
was something you said.
If you put your money into an investment over a 17-year period in the stock market, let's just say, and over 17 years you had a negative 4.89% return, would you be happy with that?
Probably not.
Right. Most people wouldn't be, right? And so, there's never, knock on wood, if you just looked at the S&P 500, we used to be able to say over a 10-year period, and then 2008 happened. But now, there's never been a rolling 20-year period where there's been a negative rate of return on the S&P 500, right? But here we are talking about a house as an investment, and yes, there's going to be fees and whatnot, but even net of fees, if you just bought and hold an index fund, for example, that tracks the S&P 500, you're going to do generally way, way better than this negative number, right? It's very, very unlikely, Anything's possible, but it's not very probable that you're going to have a negative return. All right, I got one final example here.
Well, can I just, excuse
Yeah.
me, can I just comment, because I remember what I was going to say.
Go ahead.
Most closing costs are a wash. I don't think I've ever had to pay closing costs. I think the seller paid, and I think every time I refinanced, the mortgage company paid. So I know you were talking about like roughly $5,000, but $5,000 is a chunk of change. So that's just, in my experience, I can't speak for everybody. The other thing is, and I know this may be a topic for another show, I don't know that much about it, but what I said early on was I'm a baby boomer, and my thought was, wow, I'm going to at least be here 20 years, if not longer. I also have the option, right, when I'm ready to retire, to look into a reverse mortgage with the equity that I have, right?
You could, yeah, that probably is the topic for another show. You could look at a reverse mortgage, and there's actually been more and more research done for anybody that's wanting to geek out over this. There's a guy out there, actually was a professor at the Retirement Income Certified Professional Program, which is a designation that I have. Dr. Wade Pfau, PFAU, Dr. Wade Pfau, has written pretty extensively about this, and he has a book on reverse mortgages, and it's changed over time. We're not going to have time to get into too much detail, but long story short, it is becoming more and more common. And when you look at the retirement income planning process, that's not this show, not this particular episode, we probably have talked about and we'll likely talk about again retirement income planning at some point. But when you look at that, it is becoming more and more viable for a potential retirement income solution in certain situations. And, reverse mortgages typically do have some pretty high fees and some upfront costs, and they've had a bad rap out there. And I'm not saying I'm for or against. I really do believe that it's situationally specific and dependent. However, it is something that's becoming more and more mainstream. But the one thing I'll say about that is, if somebody has equity in their home, like I mentioned earlier, it has nothing to do with them making payments or extra payments or anything like that. It is strictly based on external market forces. If we're talking about a single-family residence, a primary residence, it is dictated by comps or comparable sales, which is something beyond everyone else's control. That's why when you hear people say, well, my neighbor's house just sold for such and such, or so-and-so down the street just bought a home for this, or whatever, it's all related, right? If it's happened recently and it's in a certain vicinity of your particular home and neighborhood, then it is going to have a bearing on what your house is worth, right? So I would just say that, yes, reverse mortgage could be an option for somebody. But again, going back to following the cash flows for the purposes of today's show and whether or not a home is a good investment, it really doesn't matter, right? Like if the market goes through the roof, it's going to happen no matter what. And your counter argument is probably going to be, well, yes, however, that's equity that person wouldn't have had if they're a renter. And I would say, yeah, you're probably right. That is correct, right? But I still don't think that makes it a good investment in and of itself.
Okay. Well, we don't have to agree. One last comment before you move on to your last example. Isn't the value of someone's home part of their overall net worth when you look at, sort of their retirement goals and so forth and so on?
You can look at it in terms of a net worth snapshot, which a lot of people will do, where we take assets or the value of everything that somebody owns minus their liabilities, the value of something that somebody owes, and we net out the difference. So, for example, if somebody has a home and it's worth $500,000, but they owe $300,000 on it, we would have the $500,000 or $500,000 as an asset. We would have the $300,000 as a liability, and assuming they had no other assets or anything else to put on that balance sheet, their net worth would be $200,000. So it can be viewed from that standpoint, unless you're going to use it, like you mentioned, for, say, a reverse mortgage. From an income standpoint, it's almost meaningless when it comes to somebody's retirement income situation, absent that context, because, what is it going to do, right? You're going to have to sell it. You're going to have to do a reverse mortgage on it. You're going to have to do something. But if you're just looking at it from a balance sheet perspective, then yeah, you can look at that. But if the market crashes and that $500,000 home all of a sudden now is a $400,000 home, and you still owe the same $300,000, Well, then your net worth in that particular example gets cut in half. It goes from 200,000 down to 100,000. Why? Well, not because you, me, or anybody else did anything wrong. It's because of external market forces based on, a number of things. The economy, the housing market, the jobs market, whatever. It's all external. At the same time, if things go really, really well, and that $500,000 is now, or $500,000 home is now worth $600,000, and they owe the same $300,000. Okay, their net worth went up, say 50% from 200,000 to 300,000, right? It went up 100 grand in that particular example. Why? Once again, an external factor. It has nothing to do with what that person was doing or not doing. They just happen to own a property. And yes, generally speaking, properties go up in value over long periods of time, but keep in mind, as that happens, as they age, you have maintenance costs and repair costs and inflation and mortgage payments and all these cash outflows that are simultaneously occurring. And so it's not just like the value goes up and you become wealthier because of it. I'm not saying real estate doesn't build wealth. It does. But I'm saying, as strictly an investment standpoint, if it's your home that you live in, that you pay for, and you have all those outflows going on at the same time it appreciates, it may not be as great of a deal from a financial standpoint as you might initially think.
Fair enough.
Okay. Number 3. Last example. This is a Northwest house purchase. All right. This one's in San Francisco, California. This is actually a real property. All these are real examples, by the way. So this was an $872,000 purchase that was made in 2006. Now, we're going to make the assumption that this was done with 20% down. As we mentioned, you can certainly do it with less, right? But obviously your mortgage payment's going to be more. You're going to have more of an outflow and so on. But we're going to assume for this one 20% down. They did the same 30-year fixed mortgage. At the time, rates were about 6.35%, okay? And then later, in this example, instead of waiting 10 years, we're waiting 14 years. 14 years in 2020, they refinanced to 2.75%. Okay, that's the example that we're going to go through now. So the first part is 20% down on an $872,000 purchase is $174,400, okay? And by the way, according to homebay.com, if you don't include realtor fees, we're looking at, what is it here, 0.8% average in California, and with realtor fees, you're looking at about 5.7%. So to be conservative, we're using 0.8% for closing costs, okay? And I know you said that sellers can pay that. Not everybody pays that, and that's fine. Keep in mind that when we did our numbers and we had homes that went up in value, instead of using 2% and the 1 to 2% of the value for maintenance costs, we used 1%. And even when the value skyrocketed in some cases, we still only used 1% of the original value. We didn't use it on the new value. So there's some, nuance to this, and it's not going to be a perfect example in every scenario. But here's what we're going with. So we have $174,400 as the down payment, just under $7,000, $69,760 in closing costs, for a total outlay initially for this San Francisco home of $181,376. Okay, so we have that. Now, on this 30-year mortgage at 6.35% back in 2006, the principal and interest component, $4,340 per month. And then taxes and insurance, based on, and this is right off of Zillow, $1,294. So a total outlay, principal, interest, taxes, and insurance, PITI, for this particular example in this property, $5,544 per month. And then if we add in a 1% of the value upkeep, it comes out to an additional $726 a month for a grand total of $6,270 a month. And I'm sure the listeners can see why most people in California probably rent, because this is a pretty steep price tag for most people, right? So $6,270 a month is going to be the outflow each and every month. And before the refinance, again, we started this in 2006. We're going to do this for 14 years until we get to the year 2020. So 14 years is 168 months. Now, if we look at, before the refinance in 2020, the future value, this $872,000 property was worth almost $1.1 million, $1,089,612. At that point, okay, we were 14 years into the mortgage. So now we still owe $522,516. That's our outstanding balance. And if we were to subtract that from the new value, we would walk away with $567,096, over $500,000 in our pocket. And most people look at that and say, that's fantastic, right? But when you do the math and you solve for that internal rate of return, if you will, we're at a negative 11.15% at this point in the analysis. All right, second part here. We are going to refinance in year 14. So now fast forward from 2006 to the year 2020. We're going to refinance. Once again, we're going to reset the amortization schedule. The home is worth that almost $1.1 million at this time. We're going to assume $0 out of pocket. We're just going to reset the loan. So now, if we take 80%, we're going to get an 80% loan to value on that new value of $1,089,612. We get a mortgage for 80% of that number. Our new payment is going to be $3,558. We're going to have the same, and again, it probably went up because typically taxes and insurance go up, but we're going to be conservative and say we're going to pay the same $1,294 a month for property taxes and property insurance. We're going to keep the same $726 per month in upkeep, even though the house is older, inflation's probably happening, things probably cost more. We're just going to leave it alone. And our grand total now, instead of $6,270 per month, our outlay is going to be $5,578 per month, so just under $5,600 a month. We're going to do this, say, for 3 more years to get us to the present time here in 2023, because, again, this is a real property in San Francisco. 3 more years, that's an additional 36 months, and the value goes from almost $1.1 million to over $1.6 million in 3 years. Just to Equity Stacker's point, a lot of values in a lot of markets have shot through the roof in recent times. That's over $500,000 of equity gains, right? So now, in 2023, this home is worth $1.611,000. And if we look 3 years into that new mortgage on the amortization schedule, we still owe $813,180. And so if we subtract that from what the home is worth and we sold it and walked away, assuming we could, and this is above the capital gains exclusion, right? Normally it's $250 single, $500,000, for married, filing jointly, right? We're just going to assume we can walk away with the whole thing tax-free. We would have almost $800,000. $797,820 is what we would walk away with. And if we do the same math and we plug the same cash flows into an internal rate of return calculator, we get a whopping, ready for it, negative 6.09% internal rate of return over the entire hold period of 17 years. So again, no matter how we slice it and no matter how big the equity gains seem to be and how the markets are moving, when we really take a look at what are we outlaying every single month to own a home, again, could be a great lifestyle decision. I think it's a terrible investment. Final thoughts?
Well, I think, it's all how you look at it. You're a finance person, you're a finance professional. I'm not, but I'm not, ignorant to, how money works. However, I don't have any thoughts. You have 3 really good examples, and at the end of the day, I think it is an investment for most people based on, things that I've already mentioned. If you look at the numbers and you get really deep into the weeds, yeah, you're gonna be like, wow. But I don't know how many people, and maybe there are a lot of people that get into the weeds. I don't. I'm just enjoying life, looking long term, and as of late, like what I see in terms of home values in the neighborhood, and I think for the purposes of this show tonight was to talk about a primary residence, a single home. But a lot of people, this can be another show where you talk about buying a home and then flipping it and how those can be investments, or using the equity in that primary residence to buy other real estate, and in terms of using that money that you have in your primary residence to buy more property. I mean, that's an investment. So
yeah, I would agree. I have to interrupt here, though. I would agree, but those other things you're talking about, again, if we follow the cash flows, and I don't disagree with you, you can absolutely use essentially the money in your home, the money in the walls in some way, shape, or form to make other investments. But if you follow the cash flows of those other investments, those are generally investments that are going to put money back into your pocket, right? You mentioned flipping. If you flip a house, hopefully it's for a profit. That's money coming back into your life. If you buy a rental and you're renting it out, that's cash flow that's hopefully coming back into your pocket, right? So you're using your primary residence to do that. Nothing wrong with that if you do it correctly. But those additional purchases that are being made, I would argue, actually are investments because it's something that you're going to sell for a gain or rent to others. It's not something that you are paying the expenses for every single month out of your own pocket.
Right. And I think the average American, and again, I'm just assuming, looks at home purchase as an investment because maybe they don't, like I said, get into the weeds as much and realize, maybe I'm not making money on this, but I don't think it's a terrible investment.
Okay, fair enough. And there are studies out there. I don't have any in front of me at the moment. And again, this is not a shot at anybody who's renting. I was a renter at one time too, and I have tenants now, and we treat them with the utmost respect. But there are studies out there that show if you are, and this is a generalization, so it's not going to apply to everybody, but generally speaking, homeowners versus renters, if you look at the studies on net worth, and not just from the value of a home, but if you look at the other assets that they have and the wealth that they're able to build through other vehicles like, say, retirement accounts and, investment accounts, bank accounts, things like that, generally speaking, homeowners have a net worth that is higher than renters. And I'm sure there's a million statistics out there that you can look at and split it a bunch of different ways. And that's not going to be true in every single situation. However, I think there's certain patterns and habits, and again, at the risk of sounding like an asshole, a sense of responsibility that cultivates good habits that homeowners have that allow them, in my opinion, to go out, and other studies have shown that they're able to go out and build wealth in other areas versus renters. And that's not to say that if you're renting, like, you suck and you have no responsibility and you have bad habits. Like, that's not what I'm saying. But there are studies out there that just look at the numbers and have shown that over time. I'm just saying I don't think the investment is your house. I think your investments happen elsewhere. All right. I think we've gone for quite some time. Anything else you want to add? Any other thoughts? Anything?
No, other than, when people take a step back and really look at, how expensive it is to even purchase a house, to have a primary residence. I mean, it's almost like, as much as we want the values to go up, if they go down, then more people can buy and more people can fulfill their dream. It's just, it's sometimes it feels out of reach for people, understandably so. But it shouldn't be that way, but, it is the way of the world. So I would still say if there's a way for someone, even to buy a small home, if they don't have a family yet, and then they can, flip it or buy something bigger. I just think that that is what most people aspire to, not everybody. And again, nothing against renters. I rented for a long time. I get it. But I do think if you can, there's a lot of resources out there for people to help them with home buying. There's seminars, there's, programs at banks, whatnot, to not lose hope. Right now the market's a little crazy, but I think I'm among the majority of people that think it's not a terrible investment. And, I respect what you're saying, but we don't have to always agree, respectfully.
I agree with that, right? What do they say? We'll agree to disagree or whatever it is.
Yeah.
I want to give a shameless plug. You mentioned resources, and I actually bought this book for a couple about my age, our age. Well, not our age. We're two different ages, but my age, and they were looking at getting their first home, and they said that it was really helpful. I've read it myself. So shout out to the folks doing some great work over at Bigger Pockets, and we are not affiliated with them. In fact, I don't even think, well, maybe you can buy it on Amazon. Maybe we'll put an Amazon Associates link or something in the show notes if you want to check it out and support the show. Maybe we'll earn a couple pennies on it. But there's a book out there called First Time Home Buyer by Scott Trench and Mindy Jensen that kind of goes through the step-by-step, and more so than just the mechanics of it. They go through the tactics of it, but they also, I think Scott does a really good job of setting the framework of when are you actually ready? Do you have the resources that you need? Do you have the reserves in place? Are you going to be and put yourself in a financial world of hurt by potentially moving too quickly? So I think they do a really good job of outlining that. And again, it's called First Time Home Buyer. We'll put a link in the show notes if you want to check it out. You can buy it on their site. You can click through on our link that we put in the show notes, and I think you can probably get it off of Amazon as well. Really, really good book for those that are just getting started. Maybe they don't have their first home yet. They're looking at buying a home, and they're a little bit overwhelmed or a little bit lost or thinking, like, what the fuck do I need to know about buying my first home? Am I even ready to do this? Like, what comes next? Great resource.
Great. And also, not everybody can put 20% down. And there's nothing wrong with putting 5% down. Your monthly payment might be more, but there's always the opportunity to pay down more in the principal, refinance when the market, allows you to. And, you don't have to come up with a lot of money these days to have a home. You just have to...
I would agree with that. I would agree with that. Actually, and I'll be a little bit vulnerable here for a second. I actually did that when I purchased my first home. It's actually the home that we're still in today. And I did go ahead and put 5% down. And I did at the time have private mortgage insurance, or PMI. And my credit was excellent, and there's some other factors that go into that. But based on the additional monthly payment, which, by the way, in the first example I did at 5% down, I did not include any private mortgage insurance in there, which would have been on as part of that payment for the first portion of that example, which quite frankly would have made the numbers even worse in terms of an investment, a financial investment. But anyway, it's okay to do that. And I did that for a period of time. I had paid the loan down over time. Homes generally do appreciate over periods of time, and eventually was able to go ahead and get rid of the PMI, and have since, I've done a cash out refinance and used it for other real estate investments, and I've used my rentals to buy other rentals. I mean, there's a whole host of things that you can do, but I would absolutely, that's one thing I will agree with, is that you really need to look at your situation and look at the different types of loan programs out there, get with the loan officer, in your area that really understands the different programs, because depending on your situation, like for example, VA loans, I believe, and I'm not an expert in this, but I want to say you can get into a property with 0% down, and I could be wrong, but I don't even think that there is a mortgage insurance component. If you looked at a conventional loan, like we're just talking about, with 5% down, that's what I did, that can fall off the loan without you actually having to refinance once you reach a certain equity position. I believe at the time it was, if it hits 22% equity, it automatically falls off. If you're willing to go and get an appraisal and pay for an appraisal, you can get it removed once you have 20% equity in the home, which is what some people do. And then there's other ones like FHA programs. Again, I'm not a loan officer, I'm not an expert in this, but I think they changed the rules relatively recently on FHA loans, where in order to get rid of that mortgage insurance payment, you actually do need to either sell the property or refinance out of it, and so on and so forth. And some of those loans, the FHA loans, are assumable. There's all sorts of things out there. So definitely worth spending some time researching, reading books, talking to people that are in the business, in the industry as far as that goes, and really exploring what your options are. Not to say that putting 20% down is a bad thing. It's totally fine, and in some cases it makes sense to do that, especially if somebody has the cash, even in today's environment where rates are a little bit higher. Maybe if you have the money, you do want to go ahead and do the 20% down. But one of the things that you also want to look at, and again, going back to some of the concepts in that book, is you don't want to leave yourself with no reserves. So if you have two options, and I'll close with this, if you have two options, option A is put 5% down, but still have some reserves to handle any repairs, any craziness that goes on, any surprises. Or option B, put 20% down and then have no money. I would take option A all day long. And so, again, something for the listeners to think about. That's what I personally did at the time. Not advice, entertainment, education, ideas, information. That's all I got. Equity Stacker, you got anything else?
No, I agree with you on that last statement.
All right.
This has been fun. Thank you for having me.
Very good. Thank you for coming on the show. We will agree to disagree on whether or not your home's an investment, and we will agree to agree on some things to think about as you're considering purchasing a home if you decide to do so. Thank you very much, everybody, for listening to the show. This has been episode 52, Is Your Home Really an Investment? Featuring Equity Stacker. That's it for today. We will see you in the next episode.
Check the mic and make sure it sound right, boys.